there. And now in the US, it's become very frothy. It's penny stocks, unknown companies, a lot of option trading, etc. But the surprising thing for us here has been that most of the new customers that we've added in the last 3 or 4 months, they've been buying into pedigree stocks. So you're still not seeing like this bump up in penny stocks, or you're not seeing all of these people suddenly doing futures and option trades. So all the growth has actually come on the equity side, and that too, in the top 400, 500 stocks. So yeah, in a way that's heartening to know that probably Indian markets aren't as frothy as maybe some of the other markets around the world.
Right. And Nitin, just one question on what exactly are we seeing a lot of activity in? I mean, I think the last time we spoke, when I put out on the 9th of June, about a month back, this retail thing, you'd pointed out that volumes in cash market had gone up, and you yourself from a brokerage end had limited sort of restricted trades below for penny stocks and things like that. I mean, I think you'd mentioned that. But what kind of interest are you seeing? I mean, are we seeing largely interest from the retail community in mid caps, large caps, blue chips, or are we seeing interest slowly move down the curve?
The thing is, as of now, like just to give you an example, pre-COVID, the most held stock at Zerodha was Yes Bank by a large distance, and today it's State Bank of India, right? So we've so you can automatically see the transition there. So I think right now what we're seeing is these are all first-time investors, and they are all investing into brands they trust. So the risk in all of this is that if stock markets continues going up fast, potentially greed can take over, and people might start looking at names that are not names not like State Bank of India. So, but we are not seeing that happen as of now. We still don't see all of that build up in any case. We have slowed down. If anyone wants to buy penny stocks, etc., on our platform itself we've restricted because a lot of these first-time investors maybe don't even understand what a penny stock is. So we're trying to nudge them into staying away from stocks like that.
Okay. Let's also talk a little bit about the mutual fund data, because I just wanted to get Vijay's view on this. Vijay, it has been dismal. I mean, 225 crores of inflows is something we haven't seen in a very, very long time. Also, if you look at what's been happening with large caps, with multi-caps, there's been quite a bit of redemption. Is it purely because of profit booking, or do you think there's some other reason? And what are you assessing in terms of the flows over the next few months?
Yeah, so to begin with, I think two factors which probably weighed heavily against the funds in the minds of the retail investors. One was the fact that the correction actually changed the NAVs quite significantly, which was very disappointing for them to see. And then we had the episode of a credit sort of rearrangement that we all are aware of sometime back in the industry. I think particularly on the credit side, credit funds. So when you look at a matrix, let's say a 3x3 matrix of HNI, the mass affluent, and the pure retail versus liquid equities and credit, and you imagine those 9 boxes in front of you. The top end, the HNI credit box, is where all the red is. So a lot of outflows, a lot of negative flows actually happen from that piece. The retail, the mass app segment, actually, you could probably grade it from a little into the orange zone. The retail flows have sort of continued, so probably they continue to flow. So yes, I think HNI, mass affluent, is where the slowdown is pretty much visible, and a lot of that is probably getting shifted into direct equities. That's broadly what we are seeing.
I shouldn't ask you guys this, I mean, because since you run businesses which depend on ever-increasing flow, ever-increasing participation from retail investors, but let me anyway put this to you, Nitin. Would you? I mean, you've been you've been in the markets yourself as well before you started and started Zerodha and running this business now. Would you like institutional participation to increase quite a bit more? Would you see that as one of the drivers of a more sustainable move ahead? or would you see this as a bit of a kind of a red flag, or you think it's too early?
No, like you said, so firstly, before I answer this, just to add on to Vijay's point, see, last month for us was the largest month in terms of new mutual fund flow. So we run a direct mutual fund platform called Coin. It was the largest month for us, and I was just having a word with some of my other peers who run these online direct mutual fund platforms, enabling retailers, small retailers to invest in the markets. They've also seen actually the largest inflows into the platform. So I think, like I said, right, I think there's a dichotomy also. The behavior of retail investors is different, and the, like what Vijay just said, the HNIs and probably the super HNIs, etc., are behaving different. And the AUM, most of the AUM, in terms of value, lies with the rich guys. And so if you track only by AUM, I don't know if it's the right metric to kind of gauge the sentiment of the market. I think if you were to track by number of unique investors, etc., I don't really think that last month was a bad month. Because personally, like I said, I know some of the largest direct mutual fund platforms in the country. We are actually the largest as well. So, and all of us have seen incremental growth. Coming back to the second point of yours on institutional investors. I mean, I think every market needs all kinds of participants. You don't want it to be too skewed towards retail, or you don't want it to be too skewed towards institution. Retail investors coming in, is it a red flag? I don't think it's a red flag in India, but then for sure it's a red flag in the US. And unfortunately, US is like the mother of all markets, and something happens there, we anyways suffer from some kind of collateral damage. But I think India is still away. It's still a long time away, because the active participation in the country is still not too much. And a lot of these first-time investors, the behavior that we are seeing is that they're not really putting all their savings into it. These are all people who are putting in small amounts of money, trying out, testing out how to invest, etc. But like I said earlier, the risk here is that if markets continues to kind of keep going up, and then suddenly there is this whole, greed taking over the entire ecosystem, stuff like that happens, then potentially it will be a red flag. So, but India standalone, I don't really think it's still, anyway close to red flag.
But so Nitin, if you had to summarize it, do you think that this is a trend that is sustainable? I mean, you've seen a 244% jump in your account openings in the month of June versus the pre-COVID monthly average. And the cities that have registered the highest account openings are the same cities that have the highest population density and the highest COVID cases. So whether it's Mumbai, Pune, Bengaluru. So do you think this is just a short-term phenomenon, or is it a sustainable move?
See, the thing is, you need to think of India as a market size. So there are 5 crore Indians who filed an income tax return last year, right? And today we have, say, 80 to 90 lakh active unique investors in the market. So can potentially all the people who file income tax returns also have some direct equity exposure? It is possible, right? As in, historically, it hasn't happened, maybe because interest rates in the banks were big enough for them not to look at equities as an asset class. Now with this whole enablers of low interest rates, people working from home, people actually, even more is, people having access to internet, right? As in today, thanks to the mobile, in a lot of the past, people didn't really have access to invest easily. And today, people can open an account, get started in like 15, 20 minutes. So it's as easy as that. So all of these enablers together, can there be more participation in the country? I think, potentially there could be 2-3 crore Indians, and today we are at 80 lakh Indians. So, so potentially this market can grow 2-3 times in terms of active number of investors. But that said, if market starts going down, people don't typically open new accounts when market turns
around. I got it. Nitin, thank you very much for taking out the time. Mr. Chandok, appreciate you joining us here on CNBC TV 18. Extremely interesting discussion there, and sort of putting in context what we are seeing in terms of data, that institutional participation is now about 14%, and the rest is being contributed by retail, HNI, and maybe props, etc. as well. Well, it's time to take our first break. Let's quickly do that. We are back with a quick focus on what's happening in the commodity space. My colleague Manisha will be joining in on the other side.